While most people were watching the final candle of the trading week, something far more important happened after the bell. Between 5 p.m. and midnight on Friday, a set of routine-looking operational notices moved through the silver ecosystem. Vault updates, delivery windows, transport cutoffs, and internal settlement flags. None of them made headlines. None of them trended. But together, they changed the tempo of the physical market. The core event is simple to describe and easy to miss. Several major silver vault networks reduced or paused after-hours intake and outbound movement at the exact moment futures markets closed. That is not a price move. It is not a policy announcement. It is a plumbing change. And in commodity markets, plumbing is destiny. Most participants never see this layer. Retail traders watch spot prices. Funds track futures curves. Manufacturers care about contract quotes from suppliers. But the real market, the one that determines whether metal can move from one balance sheet to another, runs on cutoffs, custody chains, insurance windows, and delivery cycles measured in hours, not days. When those go quiet, it creates a timing mismatch between paper claims and physical availability. This is the part most people miss. Silver is not just a traded asset, it is an industrial input with a continuous flow requirement. Global fabrication demand runs roughly 1.1 to 1.2 billion ounces per year. That is about 3.0 to 3.3 million ounces per day. Electronics, solar, medical devices, and specialty alloys do not pause because futures trading has ended for the weekend. Their procurement schedules are rolling and contractual. The forcing mechanism here is not speculation. It is synchronization risk. Futures markets operate on standardized delivery cycles. COMEX, for example, clears through specific notice periods and warehouse reports. Physical networks operate on logistics constraints, trucking windows, bonded warehouse rules, insurance handoffs, and weekend custody limits. When these two clocks fall out of alignment, even briefly, the system becomes fragile. A 12-hour silence may not sound like much, but at current global usage rates, that represents 1.5 to 2.0 million ounces of implied industrial demand that cannot be matched with new physical movement. If inventories are deep and liquid, this is noise. If inventories are thin and already committed, it becomes a stress test. Public data suggests that registered exchange inventories are a fraction of annual demand, often under 10% of a single year's industrial usage. In some reporting periods, deliverable silver at major exchanges has fallen below 300 million ounces. That sounds large until you realize it covers less than 4 months of global fabrication at current rates. And that assumes zero investor demand and zero hoarding. Why does this matter now? Because the silver market is already operating in a regime of tightness. Mine supply growth has averaged roughly 1 to 2% annually over the past decade, while demand from photovoltaics alone has grown in double digits in several recent years. Even small timing disruptions can ripple. This is not financial advice. This is educational analysis only. Commodity markets involve significant risk, volatility, and structural complexity. Prices, availability, and policy responses can change rapidly. Nothing here should be interpreted as a recommendation. Consult qualified professionals before making any financial decisions. To understand why a few hours of silence in vault networks can matter, you have to separate price from plumbing. Silver trades in at least two parallel systems. One is the paper layer, futures, options, ETFs, forwards. The other is the physical layer, bars, coins, industrial ingots, and the custody chains that move them between owners. Most price discovery happens in the paper layer. On a typical day, global silver futures volume can exceed 500 million ounces in notional turnover. That is nearly half of annual mine supply changing hands on screens in 24 hours, but almost none of that metal moves. Contracts are netted, rolled, offset, or closed in cash. Physical delivery on major exchanges usually represents well under 2% of open interest in any given month. That works because the system is built on confidence that if someone did demand metal, the pipes are open. Warehouses report inventories. Approved vaults stand ready. Logistics firms operate on known schedules. Insurance policies cover custody transitions. All of it is timed. A standard futures delivery cycle looks clean on paper. For example, a COMEX silver contract represents 5,000 ounces. If a long stands for delivery, the short issues a delivery notice during the notice period. Warehouse receipts are transferred. The buyer can leave the metal in place, reassign it, or request loadout. But in reality, each of those steps sits on top of operational constraints. Vaults have intake and release windows. Many close physical movement after business hours. Weekends often operate on skeleton crews or none at all. Transport firms batch loads. Insurers define custody handoff hours. A 24-hour market is actually stitched together from multiple 8 to 10-hour physical days. When futures trading stops on Friday afternoon, the paper market pauses. But industrial demand does not. Manufacturers plan weeks ahead, but they draw from rolling inventories. If a supplier expects to source 200,000 ounces for Monday production, that metal is often allocated on Friday. If vault systems pause movement during that allocation window, the supplier must either pre-fund earlier, pay for expedited logistics, or draw down internal buffers. In a surplus environment, this is trivial. In a tight environment, it creates a cascade. Here's a simplified numerical example. Assume a regional fabrication cluster consumes 1.2 million ounces per week. Local wholesalers typically hold 2 weeks of buffer, about 2.4 million ounces. They replenish from exchange-linked vaults in 300,000-ounce tranches. If a routine Friday allocation of 300,000 ounces is delayed by 48 hours, the buffer drops from 2.4 million to 2.1 million. That is not a crisis, but if this occurs 3 times in a month, through holidays, weather, or policy changes, the buffer falls below 1 week of consumption. At that point, procurement behavior changes. Buyers stop optimizing price and start prioritizing certainty. This is how a paper market disconnect forms. Futures curves may still show contango, later months priced higher than spot, signaling ample supply. But physical buyers experience backwardation in practice. Immediate metal commands a premium because it exists and moves. The key mechanism is optionality collapse. The system works because every participant assumes multiple paths. Roll a contract, switch suppliers, draw inventory, accelerate transport. When even one path narrows, the value of the remaining paths rises. Prices do not need to spike immediately. What changes first is behavior. Now, here's where it breaks. Paper markets can absorb infinite rolling. Physical systems cannot. You cannot net a missing truck. You cannot offset a delayed bar. The moment physical flow becomes the constraint, the price becomes secondary. This is why small operational shifts, like after-hours vault silence, matter in a tight market. They don't cause scarcity, they reveal it. Every market stress reveals who has flexibility and who does not. In silver, flexibility is unevenly distributed. The people who trade price have time, the people who consume metal do not. At one end are financial actors, hedge funds, CTAs, banks, ETF market makers. They hold exposure, not metal. A fund long 10 million ounces through futures can roll forward indefinitely. The cost is a spread, maybe 0.05 to 0.20 per ounce per month in normal conditions. On 10 million ounces, that is $500,000 to $2 million. Material, but manageable. Time is a variable they can buy. At the other end are industrial users, electronics manufacturers, solar panel producers, medical device firms, specialty alloy fabricators. Their exposure is operational. If a plant consumes 20,000 ounces per day and misses 2 days of input, production halts. Idle labor, breached contracts, penalty clauses, and lost customer trust can dwarf any metal premium. They cannot roll a circuit board. Between them sit wholesalers, refiners, and logistics intermediaries. These are the shock absorbers. They carry inventory, extend credit, and synchronize timing. But they operate under balance sheet constraints. Inventory is capital. At $24 per ounce, holding 5 million ounces ties up $120 million. At $30, it is $150 million. Many mid-tier firms operate with net worth in that range. They cannot double buffers casually. When vault networks tighten operational windows, these intermediaries face a binary choice: either increase internal inventory to cover timing gaps or pass risk downstream to manufacturers. Both paths are painful. This is the either X or Y break structure. Either intermediaries expand buffers by 20-50%, tying up tens of millions in additional working capital, raising financing costs and credit exposure. Or manufacturers accept higher risk of delay and begin prepaying, over-ordering, or dual sourcing at higher premiums. Neither option is neutral. Both reprice the physical market upward even if futures remain calm. Who is most trapped? Short physical sellers and just-in-time buyers. A refiner who has sold 500,000 ounces for delivery next week, but depends on Friday allocation to source it, cannot wait for a better curve. If metal does not move, they must buy wherever it exists, often at a premium outside exchange channels. This is where financial shorts intersect the real world. Many short positions are hedges against expected inflows, scrap, door, byproduct streams. If those inflows are delayed by weather, regulation, or logistics, the hedge becomes naked. Margin requirements on futures may be 8-12% of notional. On 500,000 ounces at $25, that is roughly $1.5 million. A $2 move against them adds another $1 million. That is manageable. until physical delivery is also due. Now add timing friction. If vault intake pauses, the short cannot convert expected metal into deliverable form. They must either source in the spot market or extend delivery, often at penalty rates. Each day of delay converts price risk into operational risk. A useful historical parallel is the 2020 gold dislocation. When refineries shut down and flights stopped, paper gold in New York diverged from physical bars in London. Futures traded at premiums of $50, $70 per ounce over spot. Not because gold was gone, but because the pipes were blocked. Those who needed specific bars on specific dates paid. Silver is more industrial and less concentrated than gold. That makes it more fragile, not less. There are more nodes, more handoffs, more points of failure. What is different now is baseline tightness. In 2020, global metal stocks were ample. The problem was transport. Today, inventories are thinner relative to flow. That means any timing mismatch consumes a larger percentage of available buffer. This is the part most people miss. Stress does not start with a price spike. It starts with a buyer asking, "Can you guarantee delivery on Tuesday?" and a seller hesitating. Once that hesitation appears, behavior shifts. Orders front run, buffers grow, credit lines stretch, and the system begins to feed on itself. Markets feel stable when stocks are large relative to flows. They become unstable when flows approach the size of stocks. Silver today sits much closer to the second condition than most participants realize. Start with scale. Global silver demand in recent years has ranged roughly between 1.1 and 1.2 billion ounces annually. That is about 100 million ounces per month, or roughly 3.3 million ounces per day. Mine production has hovered near 870 million ounces per year, with the remainder coming from recycling. The system already relies on secondary supply and inventory draw to close the gap. Now look at visible inventories. Exchange-reported stocks across major venues, COMEX, LBMA-associated vaults, and regional depositories fluctuate, but combined known holdings often sit in the range of 900 million to 1.1 billion ounces. Not all of that is available. Much is allocated, pledged, or held in long-term custody. Deliverable float is far smaller. On COMEX, for example, registered inventories in some recent periods have dipped below 300 million ounces. That is less than 4 months of global industrial demand. If only 10 to 15% of total vault metal is truly mobile at any time, the effective buffer is measured in weeks. This is where timing matters. Suppose the system normally cycles 25 million ounces per week through wholesale channels. If a procedural change, shorter intake windows, weekend pauses, stricter documentation, reduces throughput by even 5%, that is 1.25 million ounces per week, not reaching buyers on schedule. That number is not abstract. It is roughly equal to 4 days of global solar sector silver consumption, or the weekly usage of dozens of mid-sized electronics plants combined. Buffers exist to absorb this, but buffers are finite. We can frame 3 simplified scenarios. Scenario A, comfortable buffer. Assume intermediaries collectively hold 120 million ounces in flexible inventory, equal to about 5 weeks of industrial demand. A 1.25 million ounce weekly delay draws this down slowly. After 1 month, buffers fall to 115 million. Behavior barely changes. Scenario B, tight buffer. Assume flexible inventory is only 60 million ounces, about 2.5 weeks of demand. Now the same 1.25 million weekly shortfall consumes over 8% of buffer per month. Within a quarter, buffers drop below 1 week. Procurement behavior shifts. Buyers pre-order. Sellers shorten terms. Premiums appear. Scenario C, stressed system. Assume buffers are 30 to 40 million ounces, less than 2 weeks of demand. Now even a 1 week disruption forces emergency sourcing. Spot premiums of 0.50 to 1.50 per ounce emerge in regional markets, even if futures remain flat. At 10 million ounces of urgent demand, that is $15 million of incremental cost transferred to industry. The public rarely sees these premiums. They appear in private contracts, freight surcharges, and priority allocation fees, but they change incentives. When a manufacturer pays $1 over spot to guarantee delivery, price becomes secondary to certainty. That behavior eventually feeds back into the futures curve. This is why normal expectations fail. Paper markets assume that physical settlement is a tail event, but when stocks are thin relative to flow, the tail becomes the body. The question is no longer, is there silver? But is there silver here now, in the form I need? Once the market crosses that threshold, small operational changes carry outsized weight. A weekend pause is no longer a footnote. It is a measurable draw on a fragile buffer, and fragility is not linear. It compounds. When physical stress begins to surface, markets rarely respond in a straight line. They react through distortions. Spreads widen, correlations break, liquidity thins in places that once felt deep. To an outside observer, it can look chaotic. In reality, it is structurally logical. The first signal is almost never a headline price spike. It is a divergence. Spot quotes in wholesale channels begin to carry small, persistent premiums over exchange-linked references. A buyer in Asia pays $0.20 over spot. A European fabricator accepts 0.35 over for guaranteed Tuesday delivery. These numbers seem trivial until you multiply them by scale. On 20 million ounces per month, a $0.30 premium is a $6 million transfer from industry to intermediaries. At the same time, futures curves may remain in mild contango, later months priced a few cents higher than near months, because financial traders still perceive abundance. This creates a wedge between what screens imply and what factories experience. That wedge invites arbitrage in theory. In practice, arbitrage requires pipes. If the pipes are constrained, the wedge persists. As this continues, three feedback loops emerge. First, inventory hoarding. Wholesalers and refiners who sense fragility increase internal buffers. If 10 firms each add 500,000 ounces just in case, that is 5 million ounces removed from circulation. At current daily consumption rates, that equals roughly 2 days of global demand. The act of hedging risk creates more risk. Second, forward demand pull. Manufacturers shift from rolling weekly procurement to monthly or quarterly pre-booking. Orders that would have been placed in March are pulled into February. This is not speculation. It is risk management. But it steepens near-term demand curves and empties nearby supply. Third, paper to physical repricing. As more participants care about immediacy, near-month futures contracts begin to behave differently. Spreads between front and second months compress or invert. Backwardation, where near contracts trade above later ones, appears. Market makers widen bid-ask spreads to protect themselves from delivery risk. Liquidity thins exactly where urgency concentrates. Observers often misinterpret this. They say, volatility is rising because traders are emotional. The real driver is optionality loss. Market makers who once assumed they could always source metal now face the possibility they cannot. They charge for that risk. This is also where forced behavior enters. A short position that was safe in a liquid environment becomes dangerous in a tight one. If a trader is short 2 million ounces in the front month and cannot roll because spreads have inverted, they face a choice: pay up to exit or risk standing for delivery they cannot fulfill. Even a $0.50 adverse move is a $1 million hit. That pressure is not ideological, it is mechanical. Cross-market effects follow. Funds reduce exposure. Risk parity models that rely on stable correlations cut leverage when volatility rises. ETFs experience inflows from investors who read about shortages, forcing authorized participants to source metal. Each channel is rational in isolation. Together, they form a loop. What should observers watch? Near-month spreads on major futures exchanges. Compression or inversion is a tell. Warehouse reports showing drawdowns in registered or deliverable stocks. Regional premiums quoted by fabricators and wholesalers. ETF flows relative to vault capacity. Bid-ask widths in front-month contracts, delivery notices, and the ratio of contracts standing for delivery. None of these alone proves stress, but when several move together, the system is signaling that timing, not price, is the binding constraint. This is why reactions often appear overdone. A $1 move on a $25 asset is only 4%. In equity terms, that is routine. In a market where margins are thin and flows continuous, it can represent the difference between a factory running and a line going dark. The market is not panicking. It is repricing certainty. Structural stress does not unfold in a single moment. It moves in phases. The first phase is invisible. Operational changes, quiet delays, altered behavior. The second phase is observable. Spreads, premiums, inventory drift. The third phase is narrative. Once enough participants experience friction, the story becomes public. The timeline typically compresses as it moves. Next 24 hours, the system absorbs, futures reopen. Most participants see nothing unusual. The paper layer resumes as if nothing happened. The only changes are in inboxes, procurement teams adjusting schedules, logistics managers flagging new cutoffs, wholesalers slightly widening quotes. Next week, behavioral shifts begin. One or two intermediaries extend lead times. A manufacturer pre-books a larger tranche than usual. Near-month spreads become more sensitive to flow. A single warehouse report shows a sharper than expected draw. Next month, either the system stabilizes or it reveals its limits. This is where scenarios diverge. Scenario 1, base case, managed tightness. In the base case, the system adapts without breaking. Vaults clarify procedures. Intermediaries raise buffers modestly, perhaps 10-15%. Manufacturers adjust procurement calendars. Futures curves flatten but do not invert persistently. Prices may drift higher, but the defining feature is not the level, it is the change in behavior. Premiums exist but remain under $0.50 per ounce in most regions. Inventories decline slowly, not abruptly. Indicators confirming this path. Registered exchange inventories stabilize after modest draws. Near-month spreads fluctuate but do not sustain backwardation. Regional physical premiums remain below $0.40, $0.60. ETF inflows are steady, not spiky. Delivery ratios remain within historical norms. This is a world of friction, not crisis. Scenario 2. Stress case, timing becomes the market. In the stress case, buffers prove thinner than assumed. A series of small disruptions, holidays, weather, regulatory checks compound. Intermediaries hoard, manufacturers pull demand forward, the front of the curve inverts. Premiums move from cents to dollars. A $1 premium on 30 million ounces is a $30 million monthly transfer. That is enough to alter contracts and production economics. Short positions become operationally risky. Liquidity in near months thins. Volatility rises not because of speculation, but because market makers cannot rely on delivery optionality. Indicators confirming this path. Sustained backwardation in front-month futures. Rapid drawdowns in deliverable inventories. Physical premiums exceeding $0.75, $1.50 in multiple regions. Spikes in contracts standing for delivery. Widening bid-ask spreads in the most liquid maturities. This is where price moves appear sudden. They are not. They are the visible edge of accumulated timing stress. Scenario 3, relief case, capacity reopens. In the relief case, the forcing mechanism is neutralized. Vault networks expand windows. Logistics capacity increases. A large tranche of metal is released from long-term custody. Scrap flows accelerate. The pipes widen. Premiums collapse back toward zero. Spreads normalize. Futures curves return to contango. The story fades. Indicators confirming this path. Sharp increases in reported vault intake. Declines in regional physical premiums. Re-expansion of near-month liquidity. Inventory builds rather than draws. Reduced delivery interest. This outcome requires action. Systems rarely self-heal without either price incentives or policy adjustments. The big picture takeaway is this. Markets are not abstract arenas of opinion. They are coordination systems. When the coordination layer, the pipes, narrows, behavior changes before narratives do. Price is the last messenger, not the first. Silver's story is not about belief. It is about flow versus stock, time versus inventory, and the cost of certainty in a world built on just-in-time assumptions. This analysis is educational only. It is not financial advice. Markets involve significant risk, volatility, and uncertainty. Outcomes depend on variables beyond any single model. Consult qualified professionals before making decisions.